Hello, and welcome to this class on monetary policy implementation when bank reserves are abundant. After 2008 and the large-scale asset purchase programs, the banking system was awash with reserves. This rendered traditional open market operations less effective for managing interest rates. In this class, we examine two new monetary policy tools created for this environment. First, interest on reserve balances, or IORB, and second, the Overnight Reverse Repurchase Agreement Facility, or ONRRP. These tools help the Federal Reserve control short-term interest rates when there are high levels of bank reserves. Let's get started. How does the Federal Reserve target interest rates? Historically, the Federal Reserve would conduct open market operations. This involves buying and selling securities to change the level of supply of reserves in the federal funds market. The figure shows the federal funds market. By adjusting the supply of bank reserves, the Federal Reserve controls the federal funds rate. Then the 2008 financial crisis arrived. The federal funds rate was cut to zero. There were large-scale asset purchases. These purchases were funded by a drastic increase in bank reserves. Reserves had grown from 14 billion in 2007 to over 2.6 trillion in 2014. We have examined this chart in another lecture. We can see the impact on the equilibrium in the federal funds market. The supply of reserves is much larger and the federal funds rate is zero. Why is this a problem? Eventually, the Federal Reserve would like to increase interest rates. However, the federal funds rate would no longer respond to small changes in bank reserves. Traditional open market operations would not be enough. Large changes in the supply of reserves were needed for the federal funds rate to respond. In theory, the Federal Reserve could reduce reserves through large-scale asset sales. I said sales, not purchases. However, the fear was that this would be too costly. Unloading $1 trillion of securities could have a large unintended consequence for financial markets and borrowers. It was deemed too risky. Two alternatives were adopted instead. First, the Federal Reserve pays interest on reserve balances, or IORB. This tool targets banks. Second, the Federal Reserve created the Overnight Reverse Repo Facility, or ONRRP. The ONRRP targets non-banks such as money market mutual funds. These non-banks are also active participants in cash markets, so they cannot be ignored. Together, these tools allow the Federal Reserve to control short-term interest rates even when reserves are abundant. Let's see how this works. We will start with interest on reserve balances. The Federal Reserve now pays interest on reserve balances. These are funds that banks hold overnight in their account at the Fed. These funds are not lent out to other banks in the interbank market. How can this help with monetary policy implementation? Assume the Federal Reserve sets the interest on reserve balances equal to the target federal funds rate. Now, banks are indifferent between investing overnight with the Fed or making an interbank loan. They will earn the target federal funds rate either way. This must be the case in the equilibrium. If the federal funds rate was higher than the IORB, then banks would lend out reserves in the interbank market. This arbitrage process should continue until the two interest rates equalize. In practice, the interest of reserves provides a lower bound on the federal funds rate. We can see this graphically. Here's the supply and demand in the federal funds market. By paying interest on reserve balances, this will put a floor on the federal funds rate. In equilibrium, no bank would be willing to accept less than the IORB by lending in the interbank market. This allows the Federal Reserve to increase the federal funds rate without changing the supply of reserves. What about the ONRRP facility? Why do we need it? How does it work? In the United States, non-banks play an important role in the cash markets, money market funds, for example. Since these lenders cannot access the IORB, they might sometimes be willing to lend at a lower rate. This is better than accepting nothing on cash that is sitting idle. This means short-term interest rates could dip below the IORB. To combat this effect, the Federal Reserve created the ONRRP facility. It is the equivalent of IORB for these non-banks. They can invest overnight with the Fed through a repurchase agreement. This facility ensures that the Fed can set a floor on the short-term interest rates. These non-banks are unwilling to lend for less than the ONRRP rate. Let's see this in action. Here's the chart showing the ONRRP rate along with the federal funds rate. As you can see, both rates track each other really well. This means that the ONRRP can help the Federal Reserve to increase the federal funds rate. Remember, this was a time when there was massive amounts of bank reserves in the system. Under these conditions, a traditional open market operation would not have worked. So let's wrap up. This was a class on how central banks can implement monetary policy when the system is flooded with bank reserves. We covered two key ideas. First, when there are a lot of reserves, traditional monetary policy tools may fail to influence interest rates. Second, the Federal Reserve created new tools, IORB and ONRRP, to provide a lower bound for the federal funds rate.